Good afternoon, everyone. Thank you so much for joining us today. My name is Rachel DeGrand, and I help coordinate the webinars for Houseman Johnson Insurance and the Benefit Services Group. I want to welcome you all to today's webinar, Calculating Qualified Health Plan Expenses. I do just have a few housekeeping items before we get started. This webinar is interactive and will feature a question and answer session. You can go ahead and type a question into the questions feature at any time, and we will address it after the presentation portion. And once the webinar concludes, there will be a short questionnaire to fill out with your contact information if you would like our team to run the calculator for your organization, and that's the calculator we will be demonstrating today. This webinar will be recorded and will be available on the webinar archives section of our website. Each attendee will receive a follow-up email with a link to the recording and the presentation slides. And with that, I would like to introduce you to our presenters this afternoon. We can go ahead and move to the presenters slide, please. We are pleased to be joined today by Kirk Pelican, who is a partner at Michael Best. His practice focuses on legal issues related to all aspects of the employment cycle, from hiring through termination and severance. Substantially experienced in both benefits and employment law, Kirk is well positioned to help clients respond to the opportunities, vulnerabilities, and benefit ramifications of particular employment decisions. Kirk's focus includes developing and maintaining effective compliance strategies related to defined benefit plans, defined contribution plans, executive compensation and welfare benefit plans, counseling clients on Affordable Care Act, COBRA, and HIPAA compliance, advising clients on Family and Medical Leave Act and disability compliance, and much more. And presenting alongside Kirk today is Mike Johnson, Senior Employee Benefit Practice Lead at Houseman Johnson Insurance and the Benefit Services Group. Mike joined our team in 2018 and brings a wealth of employee benefits knowledge and experience. He recognizes that employee benefits are often one of the top 3 expenses for a business, but they also directly impact employees' everyday lives. From his point of view, the world of insurance has become viewed as insensitive to the needs of employees and their families. To combat this, he aims to create a win-win situation for employees and employers. He works to build repeatable processes that address his clients' benefit costs, compliance, and communications. We're so glad to have both Kirk and Mike's expertise on our webinar today. And with that, I'm going to turn it over to Kirk first to get us started. Thanks for joining us today, Kirk.
Yep, thanks, Rachel. So today's agenda, we're going to go through a lot in terms of, kind of loaded with content. It doesn't mean there's not a lot more out there right now, but we're going to talk about kind of a high-level summary of where we stand with the Families First Coronavirus Response Act as it relates to these benefit credits, but kind of a higher-level piece on that. We're going to talk about the tax credits that are specifically available for eligible employers. We're going to demonstrate the calculator that has been developed, and then we'll have the Q&A. And before we jump into it, quick disclaimer, there has been a lot published on the FFCRA and a number of other laws in the last 6 weeks. A lot of it is changing, including taking an opposite approach to what existed the day before. For this reason, you will want to be nimble as you adapt to the changes, and you need to have an understanding that sometimes the advice that's given on a particular day may not be correct in the future. And so from that standpoint, you want to be nimble on that front as well, and making sure that you're not blocking out the noise, which is somewhat difficult to do in this day and age. Also, please don't shoot the messengers on this. And then finally, again, please understand that you may not be able to rely on things that are said here in the future. What we found is that IRS and DOL are both issuing what are known as frequently asked questions, sub-regulatory guidance. That sub-regulatory guidance does have shifts in it. And so those FAQs, like I say, they do tend to change every now and then. And so it is important to be watching it. How's that for a disclaimer? So the Families First Coronavirus Response Act. At a high level, what FFCRA did was it created 2 leave rights for employees working for employers that have fewer than 500 employees and then all governmental employers. For purposes of this call, the governmental employers can't take a tax credit. And so, with this, I'm going to assume it's employers with the 500 or fewer in a private sector basis. The two types of leaves that were created, one is called the emergency paid sick leave. The other one is the family and medical leave expansion. I like to refer to them as EPFL and FMLA-X. They are temporary leave rights. They're going to run from April 1, 2020 through December 31, 2020, and then they're currently slated to end at that point. And so from that standpoint, it is a rather temporary thing that we've got to adjust to. One of the things to note is that this did expand the family and medical leave rights to employers that generally haven't had to comply with it. So if you were an employer with fewer than 50 employees, you didn't have any FMLA obligations. When the FFCRA came through, it did give this expanded FMLA piece just in this one particular leave right that we'll discuss in a second to employers with fewer than the 50 employees. And so from that standpoint, you've got to be aware of what's going on here. Your status as an eligible employer is measured as of the date that an employee requests leave. What this means, for those of you who are flirting with the 500 employee threshold, you might be over it one day, go through a layoff or a furlough of some sort, and be under it in the future. Ideally, you'll grow beyond it, but it can happen in both directions. And so if you're flirting with that line, you're going to want to make sure you have a good feel for where you're at as leave requests come in. The other point I want to make on this is that if you're a small employer defined as fewer than 50 employees, there is an exception out there where if providing this leave would end your ability to operate as a going concern, you've got the ability to opt out of it. You do need to preserve documentation that bolsters your argument that you could not operate as a going concern. We're not quite sure how that process is going to roll out yet. There hasn't been a ton of definition around that exemption. And so from that standpoint, to the extent you're thinking you might claim that, you definitely want to be talking to legal counsel. In terms of the law on this, the reasons that you might take the EPFL law, the EPFL leave, there are 6 of them. So you've got the government order to quarantine or self-isolate, a physician's order to self-isolate, that the employee becomes symptomatic of COVID-19 and is seeking medical treatment. The employee is caring for an individual who's subject to a government order or a physician's order on quarantine or self-isolation, or the individual is taking leave to care for a child who's home because the governor has issued an order closing the schools in that particular area, or a government agency, it doesn't have to be the governor, or a child care closure related to COVID-19. Even within these, it's a bit nebulous in terms of what all of these generally mean. There's a 6th reason that appears on this slide. The Secretary of Health and Human Services, in conjunction with the Secretary of the Treasury and the Secretary of Labor, can come up with other reasons that this might apply. They've not done so to date. Be aware that that's out there, but right now it's not effective. Coming back, the government order to quarantine or self-isolate, what you need to know about that is that an individual is generally only going to be able to take leave for this purpose if they're prevented from working or teleworking due to that governmental order. And so if the employer is not capable of being open for work due to that order, that's not going to qualify, because the employer's closing is the reason that the individual is not working. It's not because the individual themselves is subject to that quarantine or self-isolation order. It's a broader order in that scenario. Similarly, the quarantine order is a fairly high standard. So this one, while it's in the law, is very special and narrow in terms of its application. So be aware of that. I think by and large, what we're going to see more of in terms of people trying to use these leaves is that you've got a physician's order to self-isolate, i.e. your doctor has said, you've got conditions which are such that I want you to stay home. In that scenario, you'd have somebody who is qualified for this so long as they can't work or telework from that home environment. An individual may ask for the leave if they're symptomatic of COVID-19. What we're looking there, though, is they actually need to be seeking a medical diagnosis. An individual can't say, I've got a runny nose and a headache, and so I'm just going to stay home from work. That doesn't qualify you for the EPFL. You actually need to be seeking that medical treatment associated with it in order to qualify for the leave on that basis. Individuals taking the leave under these first three bullets are eligible for 100% of their regular wage rate for that period of time that they're off, with a maximum of $511 per day. An employer can provide more than that. However, the 511 is the maximum amount that's available under the law, i.e. that amount which is required by the employer to be paid, and therefore the amount that the employer can go to the IRS to seek reimbursement for. The other two items on here in terms of caring for an individual subject to an order of quarantine or self-isolation, either from a government or a physician, excuse me, that individual is going to need to be able to show, while it says an individual, it's been narrowly tailored. So it's got to be a relationship where there's an expectation you would care for that person. So for example, if you've got an elderly neighbor, the care that you might give to that person in terms of getting groceries or something like that would not necessarily qualify under this, because there's no expectation that you would ordinarily be providing that care. Now, let's say that elderly neighbor also happens to be your grandmother. In that scenario, you might have a better argument. And so there are gradations of facts that apply here. Then finally, the daycare and school closure. These are where the individual is either needs to be cared for because they're home from school because all the schools in the state have been closed, for example, here in Wisconsin, or the child care that ordinarily would apply to that individual, be that Head Start, be that daycare, be that after school care or before school care. Summer camps are even referenced in this. Those types of closures would qualify as long as that's a regular care provider in that context, and it doesn't need to be someone who's ordinarily paid. And so if the grandmother is usually the one who cares for the child, but the grandmother is ill because of COVID-19 and therefore not available to care for the child, in that situation you have an argument for that individual that the child care closure has occurred. One other point to make on this is a spot where the DOL and the IRS have deviated. IRS is only looking at child care in the context of an individual who is under the age of 14. DOL is looking at it in the context of an individual who's under the age of 18 generally, though they both recognize that there may be an individual with certain developmental needs that requires care even though they exceed those ages. The significance is this. If I'm putting in an application to the IRS to get reimbursement for some of these claims, my application may be denied even though I'm still legally required to provide this and legally required to provide pay under the DOL regulations, because the IRS is saying, look, the individual didn't truly need care because a 15-year-old doesn't really need the care. And so we're denying the reimbursement on that basis. That's where the guidance sits right now. It's not resolved. They're both aware of each other's positions on it. I don't expect it to get resolved. So from the standpoint of making claims for the reimbursement of the FFCRA money that you might expend, or EPFL money in this case that you might expend, you just be aware that there is the possibility of a denial on that piece. We talked a bit about the child care piece. Coming back to EPFL. All employees are eligible for this. There is no minimum period of employment that applies to them. On the other hand, FMLAX, the individual must have been working for you for at least 30 days. What FMLAX gets you is up to a 12-week period of leave to be home to care for a child who's home from school or child care due to COVID-19, so similar to the EPSL rule. The first 2 weeks of that is going to be unpaid under a family and medical leave concept, but would likely be paid under the EPSL because they dovetail nicely with one another. Doesn't have to be the case, though. An individual who's taking that first 2 weeks of leave unpaid could request a different leave right that they have, PTO, for example, in which case that FMLAX would pay at that 100% rather than a 2/3 rate for the FMLAX. After you get past that first 2 weeks, then up to the next 10 weeks or up to 10 weeks can be paid under FMLAX, and that would be paid at 2/3 of the employee's regular rate, subject to a max of $200. I say up to 10 weeks because individuals who have already utilized FMLA because their employer is already subject to it will have burned available leave under that other FMLA construct and may not have as much leave under the expansion of the FMLA for the child care piece. And so it's an important thing to recognize on that. One other point to make on both of those leaves, and I won't advance the slide back. We've been getting the question about intermittent leave. And the concept of intermittent leave in this context, I'm going to say, is the in for half a day, out for half a day. I'm going to recommend that you not do it. It's an optional provision to provide intermittent leave. And the reason I recommend you don't do it is something that we'll talk about a bit in terms of the benefit calculation. But when you do this intermittent leave, it can become more administratively burdensome with regard to how you make your claims for the amounts of money that come under FFCRA. And so while intermittent leave is possible, it's not something employers are required to do, and not something that I generally recommend to my clients that they do. So what happens during the leave? So the individual's off and there's a pay element that comes, but there's also a benefit continuation obligation. And employers are obligated to continue an employee in their group health coverage during a period of EPFL or FMLAX under the same terms and conditions as if the employee had continued to work. The employees who fail to return at the end of these leaves would be subject to COBRA or state continuation coverage rules. Similarly, if an individual satisfies a waiting period during the period of EPFL or FMLAX, let's say that they weren't eligible because they haven't been with the employer for the entire waiting period to generate coverage, and then all of a sudden they trip into it, they do then get the coverage offered to them, and even though they're out on a leave of absence, would still have the opportunity to enroll. Similarly, the special enrollment rights that exist under HIPAA would still apply. So, for example, if you've got an employee who is out of, who's not on your coverage because they're taking the coverage of a spouse, and that spouse is then furloughed or laid off, and the employee comes to you seeking to get a special enrollment right in the plan, they would have that right as it exists. So how does the reimbursement work? So you get a refundable tax credit for amounts that are paid as required by the law. And so we look at the amount of the required wages under this law. Again, where it's paid at 100%, there's a limit of $511, where it's paid at 2/3, a limit of $200 per day. You also get a reimbursement with regard to the employer's share of any Medicare tax paid on those wages, so the 1.45%. And then you get a credit against any qualified health plan expenses, which is the bulk of this. Now, you may be asking yourself, okay, so what about FICA? We got the 6.2% as well, right? There is no assessment of FICA on these payments. There is an assessment of the Medicare tax, which is why there's a reimbursement available, but no 6.2% coming out of the employee's end and a matching contribution onto the employer's end. For our purposes here today, though, we're really focused on the qualified health plan expenses and what are they. The way it's defined under the law is that it's amounts paid or incurred by the employer to provide and maintain the group health plan, which are allocable to the employee's qualified leave wages, so the leave that they take under the FFCRA. Health plan in this context is defined under the Internal Revenue Code section 5000B1. Don't expect you to be an expert on tax law. That basically, though, applies to group health plans, which can include and have been interpreted to include not only your major medical plan, but also vision plans, dental plans, and that can also apply to other less, I'm going to call it a, quote, lesser plan like the HRA or the Health FSA. And so from that standpoint, employer contributions that are made to any of these, or excuse me, contributions that are made to any of these, including where the employee is fully funding the premium, can be qualified health plan expenses for this purpose. Another limiter that we do look at is whether or not they're made on a pre-tax versus an after-tax basis. amounts that are contributed on a pre-tax basis can be credited to this. Amounts that are paid on an after-tax basis cannot. And so it's a distinction that you need to realize. With regard to calculating the total qualified health plan expense, part of it is going to depend on whether or not you're looking at an insured plan or a self-funded plan. For an insured plan, you can do any reasonable method, but they suggest one of three: either that you're using your applicable COBRA premium that you get from the insurance agency, that you're looking for an average premium for all employees. You calculate an average and it doesn't matter what tier you've elected. Or finally, a substantially similar method, which is creating the average rate for an employee who's on single coverage, and then for those employees who are on other than single coverage. And that's the one that the calculator is designed to calculate. So you come out with what your qualified health plan expense is, and it's that expense that we then figure out what the portion that applies to the particular employee is. And that's what this calculator is designed to do. For a self-funded plan, generally it's the same as the insured plan, but it's utilizing an actuarial method. And the context there is that we're not dealing with a straight premium piece of it. When we're dealing with this, we're dealing with what the true costs to the self-funded plan are in this context. And so the HRA, for example, if it's a $5,000 HRA, that's not necessarily the cost that you would input with regard to figuring out what the qualified health plan expense is. It's actually going to depend on plan experience in terms of the outlay of cash that the employer has to have under that HRA. And so recognize that you can get a reimbursement for it, but there is some nuance with regard to how you calculate what the reimbursement is going to be. So how do we get the money back then? So eligible employers will retain the amounts from those amounts that they collect for federal employment taxes. And so there we're looking at, okay, what did you withhold from your employees with regard to the federal income taxes? What have you held with regard to the employee's share of the Social Security and Medicare taxes? And what have you allocated for the employer's share of Social Security and Medicare taxes with regard to all the employees that you have, not just those who are taking the FFCRA. And if the amount that you've paid out under the FFCRA, it offsets against these other amounts. And so when you do your Form 941 quarterly tax return, this is where you get the reimbursement, effectively the reimbursement kitty, or at least part of it. And I say part of it because if there's not enough in what you would remit to the government under your 941, and that effectively you haven't withheld everything that you're entitled to reimbursement, then you can get a refund of the excess from the government, or you can file a Form 7200 with the government and obtain an advance of these sums. And so as you're looking at this, it is good to be a little bit prescriptive or anticipatory with regard to what these claims might be, so that you've got a better feel for whether or not it makes sense to file the 7200, or if it's going to be a rebate that you get with the 941. Documentation. You do need to have documentation when you do a submission for these claims, for a claim under the FFCRA. Records that you're going to need to keep include records with regard to the employee's name, the date for which the leave was requested, a statement of the COVID-19 related reasons that the employee is requesting leave, and written support for such reason. So, excuse me, there you may want to have the employee fill out a request form. There's no magic to this. It's just, in terms of where the employee is indicating that they need to be home and can't work or telework, have a statement with regard to the reason for that. Where the individual is claiming that they're home because of a governmental quarantine or a healthcare provider advising self-isolation or quarantine, you're going to want to get the name of the governmental agency or the healthcare provider. If the individual is claiming that they have to care for a particular individual, There you want to get verification of the relationship. As I say, that while the law is structured as an individual, what we're really looking for is a situation where you would expect that individual would be getting care from this particular person. If the individual is home from school or a child care provider, you're going to want to get the name and age of the child if applicable, and a statement from the employee that no other person will be providing care for that child during the period. One issue that's come up is whether or not both parents can claim the credit from their respective employers with regard to care for a particular child. In that situation where the law comes out is that because there's another person that's available to do the care, only one of those two spouses would be able to claim this credit. As a practical matter, if both parents are not working for the same employer, this is a bit hard to police and something that you'll want to consider. Finally, if that child is older than 14, you're going to need a statement of the special circumstances as to why the employee needs to provide care for that child. Again, developmental disability, for example, might be where that goes. Other records, documentation showing how you determine the available credits, including the work records. So, for a part-time employee, we're looking at how many hours that they've worked over the prior 6 months in terms of figuring out an average. But also then, and this is another piece where this calculator is so valuable, is you got to have documentation showing how the amount of the qualified health expenses were determined. And so this gives you a reasonable basis by which you can show that to the government. And so having this calculator is valuable from that perspective. On a record-keeping basis, these types of claims are subject to audit, just like all payroll tax types of claims are. And so you need to retain these records, generally the last 3 open tax years. So you're looking for 4 years after the date that the tax return was due in order to retain those records for a sufficient period of time. And with that, I'm going to turn it over to you, Mike, to kind of demonstrate how this calculator works.
Perfect. Thanks, Kirk. I'm just going to show my screen here real quick. Can everyone see this all right?
Looks good, Mike.
All right, perfect. So first and foremost, everyone, thanks for joining us this afternoon. This tool was developed for really one sole purpose, and that is for everyone to use it. We don't want you guys to feel like you have to recreate the wheel. There's a lot to navigate. And as Kirk said, you have to be in middle school again here and show your math on how you're calculating these credits. So we built this calculator to give you a simple lineup on how to actually come up with your daily costs for when you're seeking these tax credits. The IRS is kind of saying you need to have a reasonable actuarial method. It's not reasonable to go out and hire an actuary to do this. So we're giving you the playbook essentially to come up with the calculations. The best practice would be to use this calculator as a starting point, but as everything starts to evolve when it comes time to file for the tax credits, I would bounce it off your accountant, internal counsel, external counsel, whoever you work with to get inputs, because as Kirk said before, this stuff is changing on a daily basis, and we don't know if this is going to be 100% accurate as we move forward, but we will continue to update this as well. So I'm just going to walk you through the calculator here real quickly. It's pretty self-explanatory. Here on the top, what you're going to want to do is just put in your client name, how many health plans you're offering. So if you're offering 2 HMOs and 2 PPOs, you're offering 4 health plans, the number of dental plans and the number of vision plans. We also have the tier structure. So if you're doing a premium tier based on single, employee spouse, employee child, and family, you would have 4. You would name your health plans depending on how you have it named within your system, whether it's an HMO plan, a plan number, or something more generic. Down here, we're going to keep scrolling. Same thing for the dental plan, depending on how many plans you offer, the tiers, the vision plan name and tiers. And that's going to give you this chart here to go through and put your outputs out. So on this chart, what you're going to want to do is make your full-time equivalent adjustment. So if everyone's a full-time employee, you can leave this at 1.0. or if we're dealing with a part-time person, you put in your FTE calculation here to come up with this cost. The second body of this is where you're going to put in your premiums for your health plan here. So if you're fully insured, you would put your fully insured premiums based on tier. If you are self-funded, you would use your COBRA equivalents or premium equivalent rates here. You'd want to put in your current enrollment by plan, and then that's going to spit out a daily cost per day for, in this situation, a full-time FTE, okay? Moving on, the same thing happens for dental and vision. On this axis, we have dental, and over here, we have vision. So you'd put in your premiums. Same thing if you're self-funded on a dental, it'd be a premium equivalent or COBRA equivalent rates, and your enrollment. And down here, it's going to show you that cost per day that you would use for the tax credit as well. The next part, as Kirk mentioned earlier, is in relation to the health FSA and an HRA or health reimbursement account. So the guidance on this isn't exactly crystal clear. So if there's going to be an area that you're going to want to pay particular attention to, definitely in this ballpark right here. So for a flexible spending account, it's basically if an employer or employee is making a deduction on a pre-tax basis, you'd use that number. So in this situation, this individual, and this section is based on an individual's enrollment. Everyone's going to have a different FSA, and the HRA amount would be different depending on what tier you're enrolling in an HRA plan with. So here, let's just assume the employee is going to take the max deduction of $2,750 for a health FSA, divide that by 12 to come up with your monthly COBRA rate. So if that employee wanted to continue to make pre-tax deductions into a health FSA after they leave, that's what the cost would be on a monthly basis, comes up with your qualified health expense there. The HRA is where you're going to need to come up with your COBRA equivalent rate for the HRA alone. And I know some people are pretty good at doing this calculation. Some people don't even have one. So if you need help navigating what that HRA amount should be, reach out to your benefits consultant or us. We'll be happy to help you with that. Okay. So this individual in this particular circumstance enrolled in single coverage on the company's HRA plan, and the COBRA equivalent rate based on the utilization projection for the cost of the HRA would be $88.52. So then when you look at how you would what you do is just add up each one of these columns for each individual that you would have take one of those leaves that you're going to be seeking for a tax reimbursement to come up with that number. This is going to be very, very important to keep in your record keeping, as well as Kirk mentioned. That's the other big part of this, is we want this to be an easy documentation process for you guys as you start to feel some of these leaves in the event that you do. If you have any questions on this, we would be happy to walk you through it in more detail, especially around the FSA and the HRA components of it. But again, this is here for you guys to use. We don't care if you're a client, a prospect, or you've never heard of us before. This is built for you guys to use this, so you don't have to recreate the wheel as we navigate all the ins and outs of these leave laws. So with that being said, Rachel, I'll turn it back over to you.
Great, thanks, Mike. Thanks for explaining. I'm gonna pop up our PowerPoint
Rachel,
here one more time.
Rachel,
Yeah.
if I could chime in really quickly, I had mentioned the intermittent leave piece, and I promised to come to something on that, and I didn't come to it. So what Mike has shown, we've got a per diem rate here, and so I had said earlier I don't recommend doing the FFCRA leave on anything other than a day-by-day basis. And the reason for that is that arguably, if you go to an hours basis, so an individual works for 3 hours in the day and then is off for 5, and that 5 is treated as this FFCRA leave, then you're going to require a further breakdown of these figures, which is going to be substantially more burdensome with regard to dealing with it. And so from that standpoint, getting it to the per diem, I think, is probably the most simplistic on this. And since you don't need to offer it on an intermittent basis in any way where you're going by the 10th of the hour, for example, I don't recommend that you do.
Great. Thank you for clarifying that, Kirk. We appreciate it.
Yep.
And then before we do get into any questions, I do want to remind you, like Mike said, this calculator is here for you to use, and we're here to help walk you through it. So how you'll be able to get access to this calculator, you can either at this moment leave your information in the questions feature, your name, your company, your email, and a phone number. Go ahead and leave that in there now, and we'll be sure to reach out to you at the end of the webinar. Otherwise, there will be a short survey as the webinar concludes, and you can put your information in there as well. And then I am going to pull up, here are Mike and Kirk's contact information. If you did want to get in touch with them, maybe you don't leave your information during the webinar here, but you decide down the road you would like to reach out, go ahead and shoot us an email. Mike specifically is very knowledgeable about walking through the calculator, and either him or a member of his team will be able to help you out with that. So with that being said, if you do have any questions about the calculator or about anything that Kirk presented on, go ahead and type it into the questions feature right now, and we'll try to address as many as we can. There have been quite a few coming in throughout the webinar, so if we don't address an answer right now to your question, we'll definitely reach out to you after the webinar is over within the next day. So with that, I'm going to scroll back up here and see some of these questions that came through. This is a good question for you, Kirk. Julie asked, regarding leave under EPFL, would the CDC be acknowledged as a government entity? We have sent employees home due to having COVID symptoms and have followed the 7-day and 3 days without a fever rule. Are these employees eligible for pay under the Act?
Yeah, and the CDC stuff, we have not viewed that as sufficient on that because it's not the force of law, right? So when you're talking about a quarantine or a self-isolation order, you're talking about something where if you violate it, you're headed in to jail, for example. And so from that standpoint, the CDC piece with regard to a recommendation that, if you came back from Italy, for example, you stay in your home for 14 days, it has not had the same force as, for example, a governor ordering that everybody stay in their home at that point. It's a bit of a nuanced argument, and I understand that. It's just where we thought when they issued this particular law, we thought that really any of these laws out there were going to qualify for it, and it was going to be a fairly easy stamp. And what we've seen out of the agencies is that it is a very narrowly tailored piece of it. And so the CDC piece, again, part of it depends on the facts and circumstances in terms of, have they been coming in from a particular country versus just, exhibiting the symptoms on their own with no, tracing to those types of situations. I realize I'm kind of circular with my response. Fortunately, it is facts and circumstances driven. I wouldn't give you a blanket statement that yes, anything that complies with the CDC would work. I think it needs to be more narrowly tailored than that.
Thanks, Kirk. Another good question that came in, if your company is approved for a Paycheck Protection Program loan, can you still claim the FFCRA tax credits?
You can. The nuance is that anything you pay out under the FFCRA is not and I'm going to butcher the terminology under the PPP, and I apologize for that, but it's not a satisfactory payroll expense for purposes of the PPP when you're trying to get your 75% spend down. For those that don't know, when you get a PPP loan, you have an obligation that 75% of what you received from the government under that loan is used for payroll expenses, which has a broader definition. And to the extent you don't hit that threshold, there are limiters that exist which cause monies borrowed to become non-forgivable and therefore need to be repaid. So what they've said, though, is that amounts that you're paying out to employees under the FFCRA do not count as payroll expenses for the PPP. And the reason for that is you're already getting reimbursed. from the government for those. And so, you know, with that, it would be double dipping if you could count it twice, is kind of the logic behind it.
Great. Thanks, Kirk, for explaining that. Another good question that came in for premiums to input on the calculator. What do I plug in if the employee is sharing in the monthly cost while furloughed or laid off? Should I only put in what the employer is paying?
So, Mike, if I could take one piece of it that you need to understand is if the employee is furloughed or the employee is laid off, amounts paid under this program are not FFCRA qualified.
Mm-hmm.
Correct.
Okay, thank you for explaining that.
Yeah.
Mm-hmm. Okay, sorry, I'm scrolling through. We have a lot of questions, a lot of people leaving their contact information. We appreciate that. We'll definitely reach out to you after the webinar and get you some information on the calculator. Yes, we are going to send out a copy of the PowerPoint presentation and a recording of the webinar after the webinar concludes, so everyone will receive that. And then as far as the calculator, if you did leave your information, we'll get in touch with you about that as well. Let me see what else here. Oh, hi, Jennifer. Thanks for leaving a note. I think that is the bulk of the questions that we've had that are related to the calculator or to the FFCRA. So I'm going to go ahead and wrap up. If you do have more questions, go ahead and keep putting them in at this time and we'll reach out to you afterwards. We want to thank you so much for attending the webinar today. Don't forget, you can also leave your contact information in the survey after the webinar concludes, or if you have other specific questions, you can leave it in there as well. We want to thank Kirk from Michael Best so much for joining us today and for explaining things so well. We really appreciate his expertise on the subject. And just another reminder, this webinar was recorded and will be available on the webinar archives section of our website. And each attendee will receive a follow-up email with a link to the recording and the presentation slides. And also, again, if you did leave your information, we will reach out to you about the calculator. Thank you again for joining us today, and we hope you have a great rest of your week.